Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of reporting an Australian superannuation on an FBAR or FATCA Form 8938. Basics, the Australian superannuation is similar to a U.S. retirement plan, sort of like a 401k. It has some aspects to a Social Security. Some practitioners treat it as privatized Social Security. It's up for debate. But generally, it's a form of pension, and it is mandatory in Australia. So if you have an Australian employer, chances are they're going to be contributing to your superannuation. Some people have multiple supers. They have companies in Australia that help people find old supers from old employers from back in the day. You may have one, you may have several. The key issue with the tax in Australia is that the growth within it is not taxable. So the question becomes, is it taxable in the U.S.? We have a separate presentation devoted to the tax rules, or how we treat them. But let's focus today's presentation just on how do you report the super. So do you have to report the super to the IRS? Yes. There's two main forms that the super has to be reported on. It's the FBAR and the Form 8938. And why don't we go through the basics of each? Excuse me. The FBAR is Foreign Bank Account Reporting, otherwise known as Foreign Bank and Financial Account Reporting, technically referred to as FinCEN Form 114. It's filed electronically. The form's been around since 1970. It was created by FinCEN, the Financial Crimes Enforcement Network, but you have to kind of disassociate the term crime with an FBAR, because 99% of the time, despite all the stupid fear-mongering articles you may read online, FBAR really has not much to do with criminal. It's the rare case where someone is criminally prosecuted based on FBAR. So the FBAR is filed electronically at the same time tax return is filed. If you apply for an extension for your tax return, the FBAR goes on extension as well. So you don't have to file like a Form 7004 like you would for a 3520A. The threshold requirements for the FBAR are the same, whether you're individual, married, separate, overseas, in the U.S. If on any day of the year, the annual aggregate total of all of your foreign FBAR reportable accounts exceeds $10,000, you have to report them all. Maybe you have one super with $800,000 in it. Maybe you have 15 accounts with $1,000 in it. Once you break that $10,000 threshold, it all has to be reported. There's not much reporting that goes on there. It's just the maximum balance for the year. Since Australia is on a different tax year, generally the year-end super report is going to be in June. Sometimes you can get a December value. If not, you just use the best value that you can, doing a diligent and reasonable search. Right? That's what the IRS wants from you. Form 8938 is the FATCA form. FATCA is the Foreign Account Tax Compliance Act that came into effect for individuals reporting on their tax returns in the 2011 tax return. So people completing the 2011 return in 2012 would have seen the form for the first time. Unlike the FBAR, there's different thresholds. For example, a single person residing in the U.S. or someone married filing separate will report the Form 8938 in any year that the year-end balance of their specified foreign financial assets exceeds $50,000. Even if the year-end value doesn't exceed $50,000, if at any time during the year it exceeds $75,000, it still has to be filed. Same concept as the FBAR, aggregate total, not per asset. To compare and contrast, if you're a married couple overseas, that $50,000 shoots up to $400,000, and that $75,000 shoots up to $600,000. So it's important to make sure you even have to file the form. Two quick things to keep in mind. The FBAR has to be filed whether or not you have to file a tax return, but the 8938 only has to be filed when you file a tax return. Therefore, if you don't have to file a tax return, then you're not mandated to just go file a tax return for the purpose of filing an 8938. We've had people come to us, gotten some bad advice. It's not required unless you have to file a tax return. One other question we used to get is about the 3520A. This is really used to report grantor trusts. It was never our position here that the super or any other real foreign retirement pension plan for that matter should be put on this form, but some practitioners were doing it recently in the beginning of March or the end of February. the IRS issued a RevProc Revenue Procedure 2020-17, which essentially says, yeah, you don't have to duplicate report employer trust. They don't specifically say the super, but the super would seemingly fall squarely into the definition of the type of trust that they're talking about. There are some other forms. There's Form 8833 for a tax treaty position. You don't always have to file that, depending on what your position is as to why you don't have to pay tax on it. Generally for U.S. persons who are receiving distributions and they want to take the position that they don't have to pay tax on it. The 8833 may not be necessary, but it may be depending on your position, whether it's the growth of the contributions, etc., etc. If the reason you have to report is because you meet the substantial presence test, maybe you could qualify for the closer connection exception to substantial presence under Form 8840. These are ways to get around paying tax or reporting it, but not required on an annual basis unless you're trying to achieve those goals. If you didn't report it in prior years, you can get penalized on it. Not everyone gets hit with fines and penalties, but if you do, they can vary. If you didn't know about it, chances are you wouldn't get hit with the willful penalty for the FBAR. It ranges anywhere from a warning letter in lieu of penalty all the way up to a $10,000 penalty per account or per occurrence per year. It's rare to get that penalty. Generally, it's a $10,000 penalty or a $10,000 penalty per year. For the Form 8938, it's generally a $10,000 penalty. If you miss filing within another 90 days, it's another continuing non-filing penalty of $10,000. Regenerates every 30 days up to a total of $50,000. If you didn't report it in prior years, then you should consider doing some of the voluntary disclosure programs. There's traditional voluntary disclosure. These days is pretty much for people who are either willful or cannot certify under penalty of perjury that they're non-willful. Even though they closed OVDP, they expanded the traditional voluntary disclosure program, which during the life of OVDP was primarily used for domestic issues. There's the popular streamlined programs. The general phraseology is the streamlined filing compliance procedures, and it's broken down into the streamlined domestic offshore procedures, streamlined foreign offshore procedures. Streamlined foreign gets a penalty waiver. There's alternatives to the streamlined program. There's the delinquent international information return submission procedures. It's a long one, DIIRSP. There's also delinquent FBAR submission procedures, and of course, reasonable cause. We have plenty of resources for free on our main website, goldinglawyers.com. We have a sister website, irsstreamlineprocedures.com, to help guide you and navigate through that program. Again, my name is Sean Golding with Golding & Golding. Enjoy the rest of your day.